two giants of the global energy sector, Chevron and Exxon Mobil, reported first quarter profit this morning, and they are bracing for the economic fallout from trade policies. For more on these two companies and these stocks, let's bring in David McAlvany. He is CEO and portfolio manager at McAlvany Financial Companies. He joins us from Durango, Colorado. David, thanks a lot for joining us. The headlines here suggest that a lower price of crude oil has led at least Chevron to scale back its share buybacks. Is that a correct interpretation?
Yeah, it is. And I think we can continue to see, a tightening of the belt, so to say. They've done a great job in terms of trimming CapEx, and, for them to scale back their buybacks is consistent with priorities such as buying shares of Hess, as an example. So I think they're doing the right thing in light of the market environment.
Is that something investors expect from these big companies, that buybacks can be a bit of a moving target based on market conditions?
Yeah, they would have to be. I mean, unless you want to see the balance sheet blow out. And I think Chevron, between the two companies, Chevron and Exxon, you're looking at a company that's managed fairly conservatively. So rather cut the buybacks than damage the balance sheet at this point.
At both companies, we saw profit retreat significantly versus a year earlier. At Chevron, adjusted profit was $3.8 billion. That's versus $5.4 billion a year ago. I think at Exxon, we saw something similar. How impactful are lower crude prices?
Well, they've been impactful. I think they'll continue to be. Of course, if you're looking at sort of the revenues year over year, Exxon is benefiting pretty significantly from the Pioneer purchase, but I do think that lower crude prices will continue to weigh on the company shares. Our base case is 50-55 for WTI and 55 for Brent crude. Okay,
you prefer shares of Chevron over Exxon in terms of a stock in a portfolio. Why so?
A couple of things. We do like the healthier balance sheet at Chevron. It's a leaner operation. We do like their dividend policy coming in closer to 5% versus 3.25%. And we think that the accretive and synergistic mix of strategic acquisitions, both PDC from 2023 and Hess going forward, will be significant. You're bringing on 300,000 barrels per day in 2026 from Ballymore. The Kazakhstan assets are amazing as a complement to their Permian assets. And as and when, and of course this is speculation, but as and when the Hess arbitration is passed, I think you're going to see Chevron as a superior company to own from a free cash flow standpoint.
David McAlvany, thank you very much. We have a breaking news event that we want to go to in Ottawa now, so we'll have to